We go. Good morning, Bruno.
Hey Nick, how are you?
How are you?
Good. How are things?
Good, good. All right, another episode of PLA, and we got two questions today. Bruno, I'll start with your question, and essentially we've had a question from a client who is dealing with selling of a investment vehicle that they have, which is a company that is obviously dealing properties, rental properties, etc. So we've talked lots about structuring of portfolios. How do you deal with an investment vehicle? What's the best vehicle for you? And the one thing we haven't touched on is when it comes to the end of this investment vehicle's life, when you've established a company, you've created something, it's got properties in it, and you eventually want to dispose of this particular investment vehicle. What do you need to look out for? What are the things that you should consider in the circumstances? So if you could just run us through a little bit of the broad strokes of that.
Sure. So what are the different ways of transferring property from one person to another? Especially if you built up a rental portfolio and you see that there's an asset of value that you're actually trying to transfer to somebody else and you're selling that asset across, maybe it's fully tenanted, you have to consider how you're actually going to go about doing this. And a lot of confusion exists on how this is supposed to be done. So obviously your most basic way of doing this is a straight up property transfer. A sale agreement, seller to purchaser, you sell the property across, the person takes ownership of the property, you value the property in whichever way that you need to value it. Residential property, you compare, commercial property, obviously has a special valuation methodology, and you simply just transfer it across. So that's obviously the easiest way of doing it. However, this does have a transfer duty that might need to be paid if it's a commercial property VAT, and obviously you have to pay the deal conveyancer some fee for the work that they're doing. Especially if there's bonds and things, you might also have to pay bond cancellation attorney. So we find in these transactions when we're structuring it that a lot of the sellers have this idea that simply moving shares across is far simpler and should be the answer to everything, right? Simply because you're not paying the conveyancer. It's a quick, easy step to avoid paying an attorney for something, right? Now, the other ways of doing this, you can transfer the property and the business as a going concern, or you can sell the shares in the business. Now, moving it as a going concern is still a property transfer. So again, people get very confused with this and they say, well, instead of moving the property, can't we just move the business? Well, that is moving the business. Remember, a business or a going concern, whatever you're running, that enterprise is its assets, right? That's it. That's what you're selling. And part of the asset is the goodwill. So when you do the valuation, a lot of people throw a lot of money behind the goodwill, but reality is you're valuing the assets, you're valuing the goodwill. Sometimes in those transactions, you don't even need to give away liabilities. It's really just value your assets, including your goodwill, and sell it off to somebody else. But that's not going to save you the cost of the conveyancer having to move the property or the transfer duty or the VAT. Well, we'll get to the VAT in a second, but it won't save you, definitely won't save you the conveyancing cost and won't save you the transfer duty if the property or properties that you're selling are residential properties, where going concerns really help and where they come in. And this is why everyone knows they exist, is because of the zero rating. If the assets or the enterprise is a VAT registered, it's a VAT registered seller, the enterprise itself is in a furtherance of a VATable supply. Everything within this business were VATable supplies, and they're moving across to this individual which is buying. So that is great because you can zero rate a transaction. All zero rating means is if the seller is VAT registered, you're VAT registered, instead of you having to pay VAT to the seller, then later knocking on SARS doors and trying to claim it back, all SARS basically says now is it's fine. Let's call it no one pays VAT, and like this is no output, there's no input, we just carry on with our lives, right? That is zero rating. And yes, that works if VAT registered, but you still pay for the transfer of the property. So now the big one where people think they're saving a huge amount of money is transfer the shares in the business. Because if you transfer shares in the company, right, that owns the business, that runs the business, transfer the shares across, guess what? you shouldn't have to pay a conveyancer. Why? Because you're not transferring a property. So the title deed of the property is not changing in any way because the company remains an owner. All that really happens is the shareholders of the company change. However, do not think that you can escape paying transfer duty simply by doing this, because SARS picked up many years ago, where people were trying to do this to escape the payment of transfer duty. They picked it up and they said, no, hold on, we're not going to allow this to happen. So what they did is, in the definition of property, they incorporated a residential property company or a group whose major assets, 50% or more, are residential properties. So although it's a great idea to shift the shares, because now you're not paying the transfer fees, you are still going to land up paying the transfer duty if it's predominantly residential properties. The only time this kind of works is if it's an entire VAT enterprise, because then you can save on everything. So that is also a good idea. Again, you don't pay VAT, you don't pay conveyancing costs. However, the downside, and this is where sometimes I actually prefer the assets moving across. Why? Assets move across, you own assets. There's no liabilities attached to it. Your assets, you own them, you know what you're getting. Your shares in a company, yes, they're assets. The problem is in the company itself. Companies have ups and downs. Companies have debt. Companies have suppliers from 3 years ago. They've got tax debt from 10 years ago, which also decides, hold on, this wasn't done correctly. You were supposed to actually charge VAT on this. I'm coming knocking on your door, and it happens to everyone. We have clients day after day coming to us going, well, we sorted out our tax issues, but now I just got a letter of demand from SARS saying, oh, it's 600,000 Rand. It happens. And even if SARS is wrong, the problem is you stepping into the shoes now in this company, and you're trying to deal with historical issues, historical debt, historical damages, things that will run the company. Maybe employee claims, things that happened previously, where employee suddenly brings it up later. There is a lot of historical issues that you don't know. So yes, you save on immediate short-term cost, but you carry a long-term risk, which could be costly or maybe not. But just be careful when doing something like this. Make sure you make the right decision for the right reasons, not just a quick cost-saving exercise.